We are going to assume a very simple scenario: a lease for 5 years with a fixed payment of $100,000 every period of a year, payable at the end of the year. The interest rate is 5%. We won't worry about whether this is the rate implicit in the lease or the incremental borrowing rate for this simple example. Let's stop and think for a second about what we are including in the measurement of the lease liability based on the scenario. In this case, we only have fixed payments which satisfy paragraph 27A of the standard. We don't have any variable lease payments subject to an index or rate, any residual value guarantees, nor any purchase options or termination penalties which we are likely to exercise under the lease agreement. We only need to worry about our fixed payments in measuring our lease liability at inception of the lease. We can begin by plotting out our payments over the lease term. We know it is for 5 years beginning January 1st, 20x0. So the end of our first year will be December 31st, 20x0, the second December 31st, 20x1, and so on until the final year ending December 31st, 20x4. We can set out what we will need: the total payments for that year, the discount factor, and the discounted payment. We can start with adding our payments, which we know to be a fixed amount of $100,000 each year. This gives us a total of $500,000 paid over the lease term. While technically this is our total liability under the lease, for accounting purposes, under IFRS 16, we need to recognize the present value of these payments, and thus, we need to discount them. To do that, we need to calculate the discount factor for each period. The discount factor determines the present value of the relevant payment. This considers the time value of money. The idea that the same cash flow received now is more valuable to us than in the future, because we could invest it and earn a return on it over the same period. Assuming a 5% per annum interest rate bank account is available to us, $100 now is more valuable because we could put it in the bank and have $105 in a year. IFRS 16 requires us to discount our payments in determining the lease liability under paragraph 26 in order to present a more accurate liability, as at balance sheet date, one which factors the time value of money over the lease term, as they could range for any number of years. The interest rate used for discounting lease payments is typically the rate implicit in the lease, or if not determinable, the incremental borrowing rate. Back to our lease liability schedule. We can now calculate and plug in our discount factor for each period. Multiplying our lease payments each period by the relevant discount factor provides us the discounted payment for that period. The total of all of these is the net present value of all lease payments under the lease. Our lease liability for purposes of IFRS 16. Now we can begin to think about our right-of-use asset. Under paragraph 24, we have a few items to consider for measuring our right-of-use asset. We begin with the initial measurement of the lease liability as our basis. We then consider payments at or before commencement of the lease term, initial direct costs incurred by the lessee, and an estimate of costs to be incurred by the lessee in dismantling and removing the underlying asset, restoring the site on which it is located, or restoring the underlying asset to the condition required by the terms and conditions of the lease. In this example, we don't have any of these. We only need to consider the initial measurement of the lease liability. We can simply plug in our measured lease liability. We will come back to this when we prepare our right-of-use asset schedule. Let's prepare our lease liability schedule to determine our journals to post at the end of each year. We start with our opening balance being our measured lease liability. Then, we need to add interest incurred during the period. Interest is to account for the discounting we have done. To calculate interest for the period, we simply take the opening lease liability for the period and multiply it by the interest rate. Make sure your interest rate matches the periods you are working with. In our instance, the interest rate is an annual interest rate. Our payments are annual too. If working with a lease with monthly payments, make sure your interest rate when discounting is a monthly interest rate. You may have to convert your interest rate you are working with to one that matches your payment periods. Now we've got our interest for the period. This is an increase to our lease liability because we are unwinding our discounting of payments as time elapses and our payments become payable. We can now add our payment to the schedule, deducting from our lease liability balance. Taking our opening lease liability, adding interest, and deducting our payment gives us our closing lease liability. Our closing lease liability for the first year becomes our opening lease liability the next year, where we can then add interest and deduct our payment again. Repeat until we arrive at the end of the lease where, if we have done this correctly, our lease liability should be 0. And with that, we have prepared our lease liability schedule. Let's now look at the right-of-use asset. We start with our right-of-use asset value. As you remember, in this scenario, it is the same as our lease liability. The only thing to consider is our depreciation expense, which we deduct. This is simply the value of our right-of-use asset divided by the lease term. Just like our lease liability schedule, the prior period closing balance becomes the opening balance. We can then do the same each year until the end of the lease term. If we've done it correctly, the closing right-of-use asset balance in the final year of the lease term will be 0. Now, with our schedules completed, we can consider our journal entries to be posted each period. The first thing we need to do is recognize our lease liability and right-of-use asset. As our right-of-use asset is based on the value of our lease liability, our first journal is to debit right-of-use asset and credit lease liability. In this scenario, we have no other journals to consider for initial recognition of our right-of-use. Asset given the full value is based on the lease liability. We had no other costs to consider. After initial recognition, we can get into the journals that we need to post routinely each period until the end of the lease term. We'll only look at the first year, as the rest are posted in the same way based on the schedule. Our first routine entry is to recognize interest for the period, debiting interest expense and crediting lease liability for the amount applicable in the first period. Next, we need to recognize our payment for the period, debiting lease liability and crediting cash, payables, or expenditure. With that out of the way, we can look at the right-of-use asset. Our only entry is depreciation. Debit to depreciation expense. Credit to accumulated depreciation. We follow the logic for the remaining periods. Journals each period recognizing interest expense, our payment, and depreciation for the period based on our schedule, until the end of the lease term. And with that, we've finished our IFRS 16 Simple Lease Worked example. Thank you for watching. If you found this helpful, please like and subscribe. If you'd like to see worked examples for other accounting topics, leave a comment down below. See you next time.